Joining us now to extend the conversation on the Federal Reserve, the San Francisco Fed President, Mary Daly, joined us for more. President Daly, always good to hear from you, so thanks for making some time for Bloomberg Surveillance.
Glad to be here.
I want to bring up the bond market, and I'm sure you anticipated I would go there first. The long bond and the rise we're seeing in yields. President Daly, from your standpoint, what signal, if any, do you take from the sell-off at the long end?
Well, you know, when you look at the long end, it is typically driven by structural factors like fiscal sustainability, geopolitical rebalancing, the massive AI investment for this industrial renaissance, which people are very excited about. And those factors are driving this. The thing that I look at specifically is this is happening across the globe. It's not just a U.S. phenomena, it's a global phenomena. And it doesn't give us a lot of signal about what we should do in the policy adjustments or the policy calibration for the Fed. And there, we look at the short end more than the longer end, paying attention to the longer end, but really focusing on the job number one, which is restoring price stability right now.
Do you think, President Daly, that the long end of the yield curve is doing some of the work for the Federal Reserve by tightening monetary conditions in a more significant way?
You know, I always hesitate to say that the market's doing our work, but what I will say is it begs the question, what problem are we trying to solve by adjusting policy preemptively? You know, there's a lot of discussion about our credibility. There, I don't see our credibility at risk. I also hear a lot about should we be making preemptive cuts or hikes rather, and I don't see a lot of evidence that that's an urgent problem to solve. So really this is about watching the inputs from the financial markets, looking at the 30, the 10, and the 2, and asking, are we getting mixed signals or different signals? And you know, right now on the shorter end of the yield curve, markets seem to have priced in a little bit more tightening, but they're reacting to the data just like we would expect them to. Inflation prints a little softer than they expect. The labor market a little softer than they expect. They push out rate hikes that they had priced in and adjust as the data comes. So I think they seem to be signaling to us that they understand our reaction function. And importantly, I'm looking at inflation compensation and inflation expectations, and you don't see any worrisome swings in those pieces of data either. So I think policy's in a good place, but watching this 10 and 30 to see what we need to think about, what are the structural factors. It's giving us a signal about something, and I think one of the big signals is the AI demand.
President Daly, we'll get into AI demand, but I am curious about the reaction function. You said that the market seems to be understanding the Fed's reaction function. What is your reaction function in terms of incoming information that would make you think that an adjustment higher for rates would be required?
Well, you know, last week I gave a speech where I talked about really there's many scenarios that could occur, but two seem very important for me at this point. One is the one that I would suggest is the modal outlook. My modal outlook is that, and also you saw in the minutes, it's a majority of the participants' modal outlook, that inflation is being driven up by a series of shocks, and those shocks will roll up, they'll roll down, they'll roll through, and as that dissipates, then inflation will return to target, in part because we have policy at a very slightly restrictive level. So there's that dynamic. But then there's the dynamic of maybe that the fact that we have so many shocks coming at once and they're overlapping, they can have an independent compounding effect. That means that the total effect is greater than the sum of its parts. The conventional dynamics of shocks just aren't working like they were. I'm not seeing evidence of that right now, but I definitely think we should keep that in mind and watching. If that happens, we'd have an inflation problem that we would want to treat with tighter policy. In the meantime, I was very supportive of the July hold and continue to look at the information that comes between now and the next meeting about whether any signs of that worrisome dynamic would be forming, and I haven't seen them yet. And the recent prints on both inflation and the labor market didn't really change that picture for me at this point.
There's been kind of a paradox forming right now where you've seen inflation above target for more than 5 years at the same time that the labor market seems to be kind of meh. I mean, it's okay, but people keep talking about low hire, low fire, and that kind of dynamic with real wages not keeping pace for the past 5 years will lead inflation to go lower. Why hasn't it, right? I mean, when does that relationship reassert itself?
Well, one of the things that is true is that we've had many periods in our history with, essentially, if you're thinking in economics terms, where the Phillips curve is very flat, and you just don't see the relationship between the labor market and price inflation. And it also kind of illustrates why the shocks have been a big component of overall inflation. You know, the tariff shock, the oil price shock, and now the AI investment boom shock. And in all of those, you have to ask, what is the expectation of their duration? Are they spreading to other sectors than the ones that they directly affect? And what do we think they will do if they compound with each other? Will that make a difference or will it not? So I think that's what's really driving it. I wouldn't look to the labor market. You don't see any signs that the labor market is contributing to inflation. And I really think at this point, you have to look at these other factors, because that link between, wages and price stability is often weak. We came off a period where it was very strong because we saw a very frothy labor market, very strong labor market, and people were saying that they were worried about a wage price spiral. I think I've talked to you both about that. But we're way past that, and now we have to look at these other factors driving inflation. And so I'd say the main contributor to why inflation has persisted for so long, even when we've had restrictive policy, is because they have these shocks, and then of course service price inflation is just stickier. It takes a while to come down.
President Daly, I'm just going to keep our audience on top of the moves we're seeing in the bond market at the long end of the curve, up by close to 7 basis points, 30s at the moment if you bring up the board, around 526. Yields higher through the levels. This is important. We've taken back much of the rally, in fact, all of it, since we had that Treasury announcement this time yesterday at 8:30 Eastern Time. Off the back of this move in the bond market, equity futures lower by 0.6% on the S&P 500. President Daly, I can imagine you'd love to avoid all the conversation about Treasury, the department and issuance, but forgive me, I have to go there. There are many people who believe we'll see a continuation of this Treasury department under Scott Bessent, of the policies that we saw under Janet Yellen, and that we'll see less issuance at the long end and more supply at the front end. If T-bill issuance continues to climb and account for more and more of the issuance coming from the Treasury, President Daly, how does that change your view on what to do and what not to do with policy? What does it mean for the everyday workings of the Federal Reserve, who is very focused on managing short-term rates?
Well, I'd say these are early days, and I wouldn't want to be preemptive in sort of discussing those types of things until we've had a chance to think through those issues. But, the Treasury Secretary is different than the Fed. The Fed is talking about price stability and full employment. And what I do know is, and we've historically been able to do this, is that we have a goal, and we can achieve those goals through our policy implementation, and we will find a way to do the job that Congress gave us, which is restore inflation to 2% as our goal as we define it, and do that price stability. So I think we don't want to worry about the mechanics of how to do that as much as the commitment to achieve it.
Forgive me for going there, but is it in conflict with what you're trying to achieve? When you see the Treasury Department attempt to manage prices and yields?
I think this is really important, but it's the Treasury Secretary's job, not the Federal Reserve's job. And we have our own job, which is very important, but also we're not quite there yet, so I'm going to focus there.
The Treasury Secretary at the moment, and you'll forgive me for pushing, is actually trying to influence financial conditions. You could see that yesterday. Yields came in. You could see the dollar weaken as well. Given the moves happening elsewhere in financial markets, particularly in crude, you do have to wonder, President Daly, if that's an increasing challenge for the Federal Reserve that they might have to confront.
It sounds like that's something you're interested in, but again, I really am I work for the Federal Reserve, and I think importantly, and I'm pushing back in this. The important thing the American people need to know is that the Federal Reserve cares about its independence and its credibility and sticks to its remit. We take in all the information. We look at everything because those are important inputs. But we know what our job is, and we focus on doing that. And that, if you want to talk about inflation compensation and expectations and Fed credibility, I'm happy to talk about those things, the labor market. But I really do think that with our job right in the importance area here, and we aren't meeting our target yet, we really have to focus there.
President Daly, how would you characterize right now the overall economy? I mean, you've talked about how there is this sort of heat coming, but right now, do you think that it's solid? Do you think it's expanding, or do you think that it's decelerating?
What I'm really seeing, and it's an interesting time. I think people say it's confusing. There's contradictory data. It is true that the typical historical ways we think and measure the economy, the dynamics and the interrelationships don't seem to be squaring up like they would typically do. So then what do you think? What do you look at? When you talk to businesses, they're cautiously optimistic. And they're cautiously optimistic beyond the AI sector, where they're just optimistic. And they're optimistic. They think of this, they call it an industrial renaissance. We are in the next industrial revolution. So they have all that enthusiasm. But what I really watch is, what are other businesses saying? What are other businesses thinking? And they're focused on the fact that consumers are trading down and feeling a little bit tighter in their pocketbooks and their spending. But they're also focused on, they keep coming to their business. They keep wanting to do things. And importantly, I start to see these businesses, I'm seeing these businesses using AI, really working hard to see how can this technology, which is in the development stage really, how can it affect their business processes, even the physical world that they work in, and what can they do to make things better? So I'd say that there's all this enthusiasm about the future and a lot of anxiety about the present. And that is a colliding piece. Now, if you talk to the consumer, they're still there, they're still spending, although it's slowing and they're trading down, but they do feel more precarious. You can see that in the sentiment surveys, either of confidence or workers. And I think it's in this low hire environment that they feel it's an uncomfortable stability. It's an uncomfortable stability that we're not really accustomed to. But the policymaker, as a policymaker, we have to ask, is it sending any weakening signals? Do we see any sense that things are fragile? And I just don't see that yet. And you saw that in the claims data today. You just don't see signs that the labor market is faltering. You simply see signs that it's running around at a very low level. And the most important question I'm asking CEOs right now about the labor market is, where are your, cutting back plans? You were in a low hiring, low firing, but do you have those plans moved to the front of your desk, and are you watching them carefully? And right now they're there. They know what they would do, but they still see that cautious optimism of trying to meet output growth where it is and be not the last in line to do that, the first in line to do that.
President Daly, you mentioned artificial intelligence and the idea that a lot of these companies were trying to deploy AI tools in lots of creative ways. Right now, is it still more inflationary than it is disinflationary in terms of productivity? Is that something that the Fed needs to combat or address, or is that something that the Fed can look through with the hopes that there will be more productivity on the other side?
This will all come down to something that we have to watch, which is this a relative demand shock? Is it changing the relative price of technology goods, or is it spreading more generally into, think of data center build-outs? Is that pushing up the price of construction workers everywhere, or is it simply, you're getting specifically trained people, or people are coming to do those things? Right now, I'm not seeing a broad spillover in the broader inflation measures. I am seeing a rise in software and technology goods. Those are pushing up, but that's a relatively small sector of the overall price indices. And so I haven't seen evidence of that, but that's what we would have to watch. And so the investment growth is very, very strong, and that's affecting interest rates, as you see, long-dated yields. But you don't see that pushing itself into price inflation writ large, although you definitely see it if you're trying to buy a high-end technology good. You see some effect there. So we'll watch that, whether that spills over into consumer prices, consumer goods and services. So far, haven't seen a lot of that. But we will. That's definitely, if your coffee maker starts rising in price because the chips that go in it, if you buy one of those new fancy ones, then if that starts going up, that's a sign of broader-based problems, or automobiles. But yet we haven't seen that of yet.
President Daly, you've mentioned that policy is in a fairly good place right now as all of the members look at the incoming data. Is there anything that's transpired that makes you question that, or has the data been more of the same to indicate that the Fed is in a good place to keep watching the data for a while longer?
I'm on the latter point you made. I think we're still in a good place to keep watching the data. As I mentioned, the two prints that have come out on inflation and the labor market didn't really clear much up for me. I'm not going to get on the bandwagon of we had a softer inflation print. We should stop worrying about the risks of higher inflation. I don't think that's right. And I don't think the labor market print suggested that there's any impending weakness there. But we have to continue to watch these things. And importantly, I think with inflation elevated for as long as it has been, we have to constantly discipline ourselves to watch what's happening to inflation expectations, what's happening to producer instinct to raise prices. Are they able to? Right now, they say they're not. They're really not pushing all their input cost increases through to prices, consumer prices. So those are the dynamics to watch, and continue to watch the labor market. But if I look at the two, we are missing on our inflation goal quite a bit, and the labor market is relatively stable. So a lot of my attention is on that inflation miss and how to get this back down to 2%, and when do I have a sufficient amount of confidence to say we're on our way. Right now, I think that's the modal view, but I don't think it's so modal. The probability isn't so large on that front that you can't watch these risks.